Recording. There we go. Now, this case, let's go now. This case, today, January, so we're January 31st. That's the first thing that we want. We want to know where we are. Where exactly we are on the time frame. January 1st, 2020. Canada entrepreneur who lives in Calgary, Alberta, and concerned about the climate change, environmental sustainability. In January 2017, that's the background information, decided to start taxi company EnviroCalp, operating in Calgary and Edmonton. Oh, you can even see it in Edmonton. This company, ECI, exclusively uses electric car. Gen plan involve first step one. So step one, incorporate standalone business and operate for several years. So she wants to incorporate the business, operate for several years. What's going to happen now, we don't know. Acquire an existing tax business and simply convert the acquired company to ESC business model. So the step 3 is the interesting one. So first we're going to buy another company and then we're going to convert it to our business model. So we have to see what's our business model, right? Jen proceeds with step 1 in January 2017, incorporating ESC, issuing 1,000 common shares with the voting right to herself and 13 million Class A preferred shares to Silent Angel investor. Interesting. Using the funds, purchase 150 electrical cars. So that's the number of cars, 150. So she purchased the cars. She purchased the meters required by the Alberta taxi industry regulation and 150 taxi license. So she purchased the cars, she purchased the meters, and she purchased the tax license issuing by the government. The draft are non-consolidated, so there's no consolidated for the most recent fiscal year have been prepared. ECI business model differed significantly. No, let's say what's the business model. Significant other than Canadian tax companies who use self-employed drivers who own their cars. Jen believes that working conditions for the tax driver are often substandard. She wants to prove a safe working environment with good condition. Therefore, the drivers are hired as an employee. So she hiring the drivers. Okay, vision to be leader in sustainable personal transportation and missions to develop a collective transportation system that's environmental friendly, social conscious, and respectful for the passenger and employees. So in July 2019, so now that's something more recent, Jen personally loaned to ESA $2 million. As the company requires more cash at that time, she and her Silent Angel investor are willing to inject more funds if required. Okay. On November 1st, Jen executed step 2. So she purchased the business. Acquire. ECI borrow from People's First Bank, so that's the borrowing, in order to purchase 100%, she get 100% outstanding common shares of the second largest taxi operator in Alberta, Ruby Taxi, called Ruby. Jen is concerned about the First People Bank loan covenants. Oops. So now we start getting interested. She's concerned about the bank covenants, loan covenants, okay, that requires both ECI and Ruby to comfort with the maximum debt to equity ratio. So we're changing the environment here, reporting environment. Calculated using their non-consolidated annual audited financial statement prepared in accordance with the accounting standard for the private enterprises. So they're looking for non-consolidated annual audited financial statements. She's considering asking the People First Bank if they will accept annual audited consolidated financial statement for ECI for the purpose of the converted covenant calculations. So that's what that probably will be the thing that we audited, annual audited consolidated financial statement. So they want non-consolidated, she asked you for consolidated. Okay. ECI expected to have positive net income starting 2022. So we're not 2020, and 2 years from now. And only step 3 remains outstanding. Step 3 was originally scheduled to take place in 2021. However, Jen is now unsure of this timing, given the recent uncertainty that the industry is facing with increased competition. So we have from ride-sharing services that have gained substantially market share. Additional information for this role is presented to your role package. So now let's, this is the background information. We have some interesting things. We know that she moved step 1, step 2. Now it's facing step 3. Now let's get this assurance requirement, flip it on the Word document and start working with them to see what we can get from here. That will be the key now for us. Right? Up to this point, blah, 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 getting the idea about the business. When is the business started, where we are right now at this moment. So let's see where we're going from here. Wallet this way, wallet this way. Okay. Let me share my screen now and continue with this. This will be the key now for us, right? That will give us idea where we're going and how we're going. Let's make it a little bit bigger and change the font to something more common.
I did the same thing.
Right? We have we have to do it, right?
Yeah.
Because here give us opportunity now.
Yep.
Now let's see who we are. You, CPA, you are the member of this member of ESA quality control team. Okay, you report to a chief quality officer, Jason, who is a CPA and certified internal auditor. The department consists 3 other members: Francis, who has a Bachelor of Applied Science in Environmental System Engineering, and 2 other members who have a Bachelor of Biomedical Engineering. Awesome. That's how that helps us. Beat me, I have no idea. But we have those people here, so we have to deal with them, right? Where is my audit? Information, insurance. So Jen has asked you, has asked the that quality control team to look into several matters with which Jason has delegated to you. Okay, what will be the matters? We don't know. There's no requirements here so far, right? The Calgary Airport is seeking bid to allow only the chosen taxi company to pick up customers for a 3-year term. Jason asked you, okay, that's one, to determine. So that's the first thing that we have to do. To determine the lowest fare that this company could bid for servicing the airport. So Jason also asked you to qualitatively assess whether winning the airport contract would be beneficial for this company. And that's that paragraph. Right? So we have 2 here, 2 assessment opportunities. Now, knowing that accounting standard for private allow the accounting policy choice, Jason asked you to assess, okay, that's number 3, what we have to assess. we have to assess the current accounting treatment for EAC tax and license. Okay, that's that will be 3A. And EAC acquisition Ruby. Okay, acquisition Ruby. That's number 3. That will be 3B. 3B, which is currently accounted at for cost, comma, as well as explain, now we have to explain how the leases, that's 3C here, and the convertible debt, okay, so how the lease, highlight this one, and convertible debt here, that will be another one for us, 3 ABCD. Let's go. From step 3 should be accounted for. In addition, Jason asks you to assess, okay, so that's another one, that's number 4. The accounting treatment for the stock options. Okay, so we have to get accounting treatment for stock options, that's 4A. And stocks appreciation rights. Okay, that's another one for us. That will be 4B. Right. The only thing that here has to assess and explain. So this explain, we may flip it to number 4 here, right? Because this is another action verb. To assess is 1, 3, and that might become a 4C, and that can become 4B, 4A, 4B, right? That's the only thing that I'm looking for, and then I'm looking, that will become number 5 for us, and that will be 5A and 5B. That EC granted in 2019 to its employee, and to recommend, so now another action verb here, and we have to recommend. That will be number 6 for us. Which financial instrument to grant in the future? Okay, that's that paragraph. So in this paragraph, we have a lot of requirements. 1, 2, 3, 4 requirements. Ruby, now let's see, Ruby has had annual audit in the past, but ECI financial statements have not previously been audited or reviewed. First, bank now require each of the company to obtain an external audit for the separate entity financial statements to help the company management understand what they can expect. Jason had Francis prepare an initial audit planning memo to ECI and ask you to. Now that's the action verb to comment on. Now we have to comment on. What we have to comment on? Let's see. That's number 7 for us. Comment on it. Jason would also ask you to recommend. Now we have to recommend. Right? That we audit procedures. That's number 8 for us. Audit procedure for ECI and Ruby financial reporting issue he asked you to address. So which are those reporting issues? Those reporting issues are acquisition of Ruby and all the other things that are related to Ruby. Right? Is that where the sentence here? Ask you to comment on it. No, the comment, oh, sorry, no, not this one. To comment on it, that's where the sentence stops. That's the paragraph stops. So we have to do here. We have financial parcel, obtain external auditor It's a financial statement. To help ESC to understand what they can expect, Jason had prepared the initial planning memo, so he asked you to comment on it. Initial planning memo. Okay, Jason will ask you to recommend audit procedure for ESA and Ruby financial reporting issue he asks you to address. In addition, Francis has audited accounts receivables, plant equipment and balances, and Jason asks you to review. That's number 10. No, number 9 here. Number 9, the work. And that's where the paragraph stops. Now, because Ruby's drivers uses their own meters, Jason is concerned that they might not pay the full amount of the royalties on. He asks you to explain, okay, I have to explain, that's number 10 for us, how this might have occurred, and discuss, now that's another action verb for us. Once we explain, we have to discuss what internal control will ensure that Ruby receive all royalty revenues. Now I have to get the copy from the document, get a little bit more. There are 3 more paragraphs. Okay, we're done with this. Let's go to the next one. Let's format it. Put this here. Okay, management is eager to prepare for the Calgary Airport contract. Should ECI be one of the successful bidders? Therefore, Jason asks you to draft a memo. So now we have to draft. That's number 12 for us. Let's see what's on the memo. Management describing. So we have to describe the procedures. An external auditor would perform in order to provide the report required by the Canadian Airport Authority. So you have to find what's this report. Finally, let's move this one up a little bit. Okay, like this. Finally, since the quality control team will now be dealing with the external auditors, Jen asks Jason whether the external auditor will be able to rely on the work on the quality team, and if not, to make a recommendation that will ensure that that this is possible going forward. Jason asks you to draft this memo. So what's on the memo? Now we have to ask you to whether the external were able to rely. So that's the one thing. Is the external auditor able to rely? That's number 13 for us. And also we have to make a recommendation to recommend. And that will be number 14 for us. To ensure that it's possible going forward, Jason asks you to draft this memo. Okay. And that's about it. Right? Yeah. So now let's jump to the actual memo now, not the memo, the case, and go to the answers and see what we get and what we miss. That will be the interesting part now. Did we get first everything from the case? That will be the first part that we have to do. Make sure that we understand and know what we're doing. That's exhibits, additional row. That's not the one that we're looking for. Ah, here. So first, candidate provide the quality analysis of Calgary Airport. I think we got that one, right? To determine the loss fare that will could be the servicing. So we got this one. Can I provide qualitative? No, quantitative. So sorry, quantitative analysis. That will be quantitative analysis will be the one that we have to calculate about the bit, right? So we get this one. Let me show you. Ask you to determine the lowest fare that could bid for servicing airport. Our number one is matching their number one as answer. That's good. So let's go to the next one. What else we have to do? How is done? We're going to deal with this when we start doing managerial accounting, not right now. Now focusing only on the assurance. The candidate performs a qualitative analysis of the Calgary Airport bid. So did we get this one?
Isn't the qualitative isn't that management accounting?
It is management accounting. Qualitative,
Wait,
yes. We got it, the qualitative. So
yeah,
we got it as a requirement, right? I'm just
it's a
checking.
requirement. Okay,
Yeah.
yeah,
I'm
to
just
see
checking, did we get everything?
everything.
Are we missing assessment opportunity or not right now? That's where we are right now. Make sure that we get everything. So that means we're reading the requirements carefully. Next one on the case is it's clearly says first one here, it's core management accounting. Next one is the core management accounting. Next one is candidate discuss potential impairment of the taxi licenses. So that's potential impairment of the taxi licenses. That's financial reporting. Let's see if we get this assessment opportunity as well. So to assess the current accounting treatment for the taxi licenses, we get that one. We have the licenses. Let's go with the next one. Next one is accounting, discuss the accounting for ECI investment in Ruby. That's number 4. Did we get this one? I believe we did, right? Investment in Ruby, acquisition of Ruby, assess for ESA acquisition in Ruby. We counted 3B, but we got it as a assessment opportunity. So it's identify. Then we have to explain. What do we have to explain? Let's see, what's the next one? That's financial reporting, right? Those two are financial reporting, taxi driving licenses and this one. Then we have to discuss accounting for electric car leases. That's still financial reporting here for us. Explain how the leases and convertible debt. So we have leases here. Now the next one should be the convertible debt. Let's see if that's actually in fact true. We got the leases. And the next one is related to convertible debt. So we got this one as well. Okay. And then going to the assurance row. Now, assurance row, the candidate discuss appropriate accounting for the stock options and stock appreciation rights. That doesn't seem like a assurance row, right? Because there's no assurance here, and recommends. So we have to discuss appropriate accounting for stock options and stock appreciation rights,
No,
right? And
actually,
recommend.
it's assurance. The
It
stock
is assurance.
appreciation. Yeah, it's part of assurance.
Is it? Okay.
Yes, it's on its own. That one in the. So usually, what they do, what I've noticed in the case is that in assurance, they're gonna bring one thing that's gonna have like a calculation or something to discuss about that is just different. That is not the process. It's just
I
on
see.
its own. They usually
Aha.
just so stock option was the situation here. Remember on the other case we did last week, there was
Yeah.
a recalculation they needed. They
Right.
bring in things like that on assurance. It's always gonna be like there's one element they're like, do something for us here, which
Okay.
is unique. Yeah.
But let's see later from where this one's gonna come. How we will
'Cause-
know that this is assurance,
yeah.
right? So, but let's see later when we're reading the case what's gonna happen. So the question is, do we get this one? We have to assess the accounting treatment of the stock options and appreciation rights, and to
Yeah.
recommend. So we have those two. We get those two. We understand that we have to do them. So what's the
Yes.
next one? Next one is here. Once we finish with this, the next one is to provide comments on the audit planning performed by Francois. Did we do that? Did we get this audit planning? So, comment on initial audit planning memo from Francois. Okay, we got this one. Next one we have to do is recommend audit procedures for the financial state, for all the problems that we identified: tax license, acquisition, lease, convertible debt, stock options, stock rights. Let's see if we get those one. No, actually the stock options, stock rights we don't have to do, but for the assess the current taxi license, acquisition, lease, convertible debt, right? That's what we're chasing here. We have to recommend audit procedures. And also we have to review the work for accounts receivables and property plant. Let's see if those one coming as assessment opportunities for us. Audit planning performed by Francois. So Francois performing audit planning. So he goes with the financial statements. We're commenting on the audit planning. And then we questioning, recommend the audit procedures of the financial reporting issues. So tax licenses, investment in Ruby, leases, convertible debt, stock compensations, and stock compensation package for the stock options, stock appreciations. All right, so next one is candidate provide review comment on the audit work performed by Francois on the accounts receivables and property, plant, and equipment. So we did that one, so we got this one as well. Next one is the candidate discuss how the Ruby drivers may not be paying full amount of royalty and recommend that. So we have discussed and recommend. I believe we got that one too on here. So we're gonna do the explain on meter. So we have to explain and discuss MyCure and discuss what internal control to ensure the Ruby receive from the royalty revenues. So those are the driving licenses. So we get that one as well. Okay, next one that we have here is to draft the memo for describing procedure for the external audit perform work on the Calgary airport. Let's see if that's coming as assessment opportunity here. So this is describe procedure that internal auditor, okay, that's the one, the number 12, and number 13, what's the number 13? Discuss and recommend ensuring the license possible going forward. That's discuss the external audit would be able to rely on the work and what we do going forward. And okay, where we are on this one. Did we clearly identify that? Yes, whether the external audit will be able, recommendation possible going forward. Okay, we got that one as well. So basically, what we did in our reading and identifying assessment opportunity, we haven't missed anything.
Okay.
Right? That's
Yeah,
a good thing.
yeah.
That's it.
We
That's
have
a very
not.
good thing, right?
Yeah.
Okay, so that gives us some confidence that we are reading the things
Correctly.
correctly, right? We have here the initial audit planning. We have the audit planning memo that we have to do. And then we can audit procedures all related to our things. So basically we caught everything. So let's see now where the answer comes from. and how the answer related to the requirements that we have. Obviously, we're going to have, let's go first over what I wanted to go over. Let's go briefly over the materials that they're providing for the whole rows here. This is the page 65. Let me mark it somewhere. Page 65 is where the requirements start. Not 65, 71 is for me. Okay, so here we have the financial statements. What we can see of financial statements, the revenue goes up, expenses going down, operating cost is ginormous, depreciation steady, license amortization steady, publicly promotion steady, wages and benefits are increasing. Dividend from Ruby, why this dividend sitting here, I have no idea, but we have to figure out what's going on here. Then we have the interest, and we have the interest to the shareholders loan. And we are accumulating losses, right? We're working, we're starting, yeah, we're starting 2017, right? 2017 is our first year of operation. Look at the deficit opening balance.
Jesus Christ.
Right?
Yeah.
So that means the first year, that's how much was the loss first year. Then we get in this loss, opening balance getting here, the closing balance there, because this plus this is going to give us this. Right? So the first year we're losing 2 million, the second year we're losing another 2 million, and the third year we're losing another 1 million. So so far we're losing $5 million, but we're still in operation. How this is possible? No idea. So let's see balance sheet. Balance sheet, surprisingly, we have cash. Accounts receivables going down. Property, plant, equipment.
We got cash from the bank.
Right. Licenses, the value of the license is going down. Obviously, the assets, property, plant, equipment going to go down. Investment in Ruby at cost. Why the investment Ruby at cost? Is it at cost?
Even hold on. Quick question.
Yeah.
From the P&L, we see that they're in a deficit, correct? If not for the fact that the case would have said we are not going to assess any going concern. If they had not mentioned that, that was a direct going concern situation, correct?
That's correct.
Okay. Perfect.
2 years in a row in losses, that's directly going concern.
Okay, perfect. Thank you.
But don't forget, we have this angel investor who just pumping money, right? Also, there's a statement in the case, if you remember, she put 2 million, and she's okay.
She's willing to put more.
Put more. So this business don't have that going concern, because their intention is to keep going. Because their projections for 2022 to making profit. 5 years. Oh my God, 5 years to start making profit. That's nice. So why the investment in Ruby? My question will be, why is in cut cost? When this investment, when in Ruby, she purchased my memory tells me that she purchased that Ruby 100% of the outstanding shares. So basically, she has control over Ruby. Right? Why is at cost when it has to be use an equity method? That's a mystery for me. So that probably will be one thing that we have to fix, from cost to flip it to the equity method. Okay, so then we have liability, sales tax payable, trade payables and accrued liabilities. Nothing shareholders loan, and the loan to the bank, that's $5 million there. Okay, so then we have this property, plant, equipment schedule, licenses, cost cost of the licenses, where the licenses are, shareholders loan, bearing interest 6%. Common shares, 1,000 common, preferred shares, 30 million, Class A preferred shares outstanding. The holder of the preferred shares are entitled to cumulative dividend of 9%. No dividend has been declared. Okay. So also government regulations, that's transportation of the passenger car for a fare requires taxi licenses. The government regulates issuance of the licenses and set of safety. Government instituted the tax licensing system early 60. That's the background of the taxi. Now, once issued license can be bought and sold on the open market. So there should be a value for those markets, for those licenses, right? So since we're going with that direction, those licenses should have fair market value if you can sell it on the open market. The purchase is extended to the same rights on the previous owner, subject to compliance with the government regulations. 2018 government sold 150, now they say 150, new 30 years licenses to this company for $30,000 each. So that's explained how we get those 40.
Sorry, you're breaking. Sorry, you're breaking. There's a communication. I can't hear you. Can you hear me?
$4,500,000.
Hello? Hello? Hello?
Of the last, I can. Can you hear me? Hello? Hello? Hello?
Yeah, it was breaking.
Yeah,
Can you hear me now?
Yeah, I can hear you. I'm hearing you all the time. I have no problem with the hearing you. I guess
Yeah,
you.
my internet might be a problem.
No. It usually is mine. It's usually mine because yeah, I'm on the cable, not on the any other but it's wireless. I'm on the Wi-Fi network, right? That home is kind of tricky because I'm using screen which is here available. I don't have a wired internet at home. Oh, it's Wi-Fi. That's why sometimes it's crappy. Sorry about that. Tomorrow will be fine because tomorrow will be at work. So tomorrow tomorrow still gonna be at home. We'll see how it goes tomorrow. I hope it's gonna be fine. So let's go now where we were. Page 72, I believe. 72, 73, something like that. Licenses. Where did they lost you? Here on the licenses?
Sorry?
Hello? Where did they lost you? On the licenses?
Yeah, I think on the licenses. Yeah.
Okay, so we have 150 licenses, $30,000 each, which explain our cost. Right? That's good. This was the market value data compared to approximately $100,000 at their peak several years earlier. So the license was worth $100,000. Now it's getting down. The government regulates the fare, which can vary from city to city. For example, the Calgary fare is currently $5 flat plus $2 per kilometer, regardless of the type of the vehicle. However, Airport Authority regulates the fare for trips starting at the airport. Okay. So we have this industry business model. Apart from the ESA, all tax companies in Alberta operate under the same business model. The taxi drivers supply their own cars, electronic meters, taxi licenses, and pay all the costs to operate the cars, such as gasoline, insurance, maintenance, and registration. Drivers sign an exclusive contract with the taxi company. The contract enables driver to access company dispatch services. When the passenger calls the company to request a taxi, the dispatcher sees the request to a driver through the meter installed in the car. The driver are self-employed contractor who pay fee to the company for the dispatch and other services. The fee generally a percentage of the overall fee. For example, Ruby drivers pays a 7.5 royalties to Ruby at all fares. So basically, this business model works for Ruby,
Yeah.
right?
Yeah.
Now, for our company, for this ECI business model is ECI own the cars, meters, taxi licenses.
Yeah.
Its driver are employee who paid are employees who are paid an average of $18 per hour, including benefits. Drivers are required to work 40 hours a week and are not allowed to work overtime. Driver return the car to premises at the end of each shift. Determine the schedule and territory of each driver covers. Passengers pay fare, which belong to EC. Each car has a meter that's linked to ESC system. ESC incurs all the costs of owning and operating the vehicle. The cost of charging the electrical car is approximately 0.2 per kilometer travel. Annual insurance and registration cost for each car is $800 and $250 respectively. Car repair, maintenance, inspection cost are estimated $1,500 annually plus 15 cents per kilometer travel. Regardless of the usage, each car is subject to annual depreciation expenses of $4,000. How they come up with the $4,000, we have to check, right? Ride-sharing services. The recent years, several ride-sharing services have emerged in Alberta that are competing with traditional taxi services. Ride-sharing drivers do not require taxi license and use their own car to transport passengers who use the smartphone apps to request the ride. These services are tolerated by the Alberta government due to their popularity. Taxi drivers are extremely unhappy and have staged number of protests, having paid significant amount of money for the purchase licenses. Their feel unfairly treated by the government. In addition, the open market for the licenses have stalled because buyers are waiting until they're more certainly regards the government's view on the ride-sharing services. Although Jen is satisfied with the financial future, given its current projection, she wonders if the EC license impaired because of the marketing changes. So that's where it drives us to the impairment of the driving license. Make sense? So from here, we have to extract all the information but that will be for the financial reporting, right? Since this is a common information, right? From here, we should have the idea. The other thing that's going to drive us here is, watch this. A few years ago, the driver's license was $100,000. Now it's $30,000. Several years later, it's $300,000. That's 70% decrease. And having in mind that we have the ride sharing is the impairment. Most likely there's impairment.
Yeah, it's an impairment analysis.
Right.
But my question is,
yes.
The thing is, with this case, the problem is that there's an impairment analysis. However, I know we're not doing FR stuff, but however, this is an ASPE case. And ASPE does not do
impairment.
It doesn't do it does impairment, but then it doesn't use the revaluation method.
Okay.
I'm wrong.
We're gonna see. We're gonna see about this. Let's leave the financial reporting for now. Let's focus only on assurance. We're chasing assurance but we still have to comment on the assurance on the licenses, right? On November 1st, purchased 4 million outstanding common shares for Ruby for 3.1 million. Ruby also has December 31st year. Most taxi businesses in industry own very few tangible assets, and they generally lease their premises, and the driver own their cars, licenses, and meter. Taxi companies are usually brought for their reputation, faithful client base, and brand recognition. Ruby owns the land and the building which operates, and they earn rental income 75% of the building for space not used in operations. At the time of the ESA, it accrued this subsidiary, so it's subsidiary, or no questions about it. Control is established. Definitely consolidation. The carrying value of Ruby net assets under ASPE was 1.16. Why she's paying 3 million? That's triple. According to the independent appraisal hired by ECI, the fair value of the Ruby assets and liability at the time of acquisition were all equal to the carrying value except the land, which had a fair value of 800,000 compared to the carrying value 500,000. So that's 300,000 increase allocation for to the purchase acquisition to the purchase differential. On the acquisition date, the building had outstanding mortgage payable of that much. According to Ruby internal financial statements, the net income earned by Ruby for the 2 months period ending December 31st was 250, which is our income, right? Ruby income is our income, no questions about it. On December 31st, Ruby declared and paid $100 dividend to ECI. That explained that dividend, right? Here we have here dividend.
Where on the acquisition?
No, on the financial statements, on the income statement. The income statement of ECI and ViroCap. Can you see it on the screen?
No, I cannot see on your screen. I cannot see it, but
Oh,
I'm not.
hold on a second. Hold on a second. I'm not. Which screen? Let me stop this sharing. Let's get the new sharing because I'm moving here. How about this one? Can you see
Yeah,
it? Now the
dividend from
dividend,
Ruby.
100,000. And this is exactly what they're saying here. The dividend here is 100,000 for ECI. That dividend should increase the investment, should reduce the investment, right? Under the equity method. We're not using for the acquisition of full control. We're not using cost method. Cost method is used when we have we don't have non-controlling interest. When we have a non-controlling interest, then we're using the cost method.
Cost method.
Right?
My
So
question is for
yes,
this one, because they purchased the entire company, right?
yeah,
Is this like a business combination?
yes, it is business combination, but still on the
Okay.
business combination, you reported us on the equity method, using the equity method, right?
Okay.
Equity method, you put in the investment, and then dividend paid from that subsidiary is going to reduce your investment, and the income of the subsidiary is going to increase your investment. That's how it's recorded, right? Now they're doing different things, so that means the $100,000 is going to affect our operating income because we have to remove it there and put it as investment. So let's see what else they're having. They're having this financial projection. That's a nice projection, but how did they come up with the numbers? We have no idea. And the financial costs are comprised the interest on the bank and the shareholders loan. The full balance of the loan is due on December 31st, 2024. So in 2024, we have $3.1 million. Okay. What's next? Step 3. Oh, the step 3, to convert Ruby into our business model. Right? Remember that was the step 3. Step 1 was to get a business. Step 2 was to get Ruby, and the step 3 to convert Ruby to our business model.
Yep.
So the step 3 involved acquisition of 200 new cars and hiring Ruby current 200 self-employed drivers as employee. Ruby will lease 120 electrical and has agreement to in principle with the car financing to lease the car for 7-year term on the monthly payment 5 years per car. The car currently sells for 40,000 each. At the end of the lease, Ruby may purchase the cars for 5,000 each, which is the estimated fair value at that time. Okay, Ruby will purchase 80 electrical limousine taxi, so that's how we're making those 200 for 50,000 each, financed through the long-term debt. The new debt will be payable in 5 years and will bear annual interest 4% payable at the end of each year. The debt will be convertible into the option of the holders into 1 million common shares of Ruby. The Environmental Agency Fund, a government-based backed venture capital fund, has already expressed interest providing the debt. The market interest rate for similar debt without the conversion feature is 6%. The limousine is expected to have useful life 10 years. If this company ESC business model is implemented for Ruby, each new car is expected to have the same annual insurance inspection, registration, maintenance costs for the same electrical consumption per kilometer travel. Okay, that's why we go getting this. Remember, there was a requirement to comment on the lease and on the convertible debt. That's why we're getting those numbers. So now we're going to last one, the airport bit. Starting 2021, the airport is offering exclusive access to its premises for the 3 taxi company. Instead, interested company must be submit their bid proposing a set fare for the trip from the airport anywhere in Calgary area. The 3 lowest bids will each be awarded a contract, and the standard fare will be the average of the 3 company bids. All companies will be required to comply with a certain performance measure as established by the airport. Airport officials state that the average 3,000 taxi trips depart from Calgary Airport daily, and the 3 companies selected will have the rights to approximately 1/3 of the trips. So that means 1,000 trips. The average round trip is 20 kilometers. If the company is the only is one of the winning bids, ESA will allocate 40 cars to the airport use only from 6 to midnight daily. The airport will require minimum number of taxis to be at the airport during that time. It's established that the car allocated to the airport will miss out 30 trips daily that would otherwise have provided airway sales in the city. So that's our opportunity cost here. However, those trips are shorter, averaging 8 kilometers each and providing average fare of $21. That's exactly the opportunity cost that we're seeking here for calculation, but that's from the managerial accounting. So we're done with the basic, right? So let's see now the assurance. First, start with the stock compensation package. Okay, so now I understand why the stock option and stock appreciation rights are part of the assurance. Right? Now we understand why. Because the information is given only and only in the for the additional information for the assurance role. Make sense?
Okay, makes sense. Yeah.
Okay, so if that is happening here, then the other roles, they don't have that information, so they don't have to deal with this. Okay, so in January 2019, they estimated the value of shares to be $1 per share. Estimated value of the shares was $1 per share. So that's a private company, right?
Yeah.
So how they estimated the value, questionable, right? So each of the driver, 150 driver, was given a choice of 2 stock-based compensation packages. First, 1,000 options, entitling them to acquire 1 non-voting common shares per option at an exercise price of $1, or 1,000 stock appreciation rights entitled them to a cash payment representing the difference between the market value of one's shares, one share at the time, right? And $1 benchmark value per share. For example, if the shares worth $1.85, the holder of the appreciation rights is entitled to the 85 cents per share. Right? So they're giving anything above $1, they're getting as a cash appreciation. stock appreciation, right? To get it in cash. Only driver who satisfied the 5-year vesting requirement will be eligible to exercise the entire either instrument. So we're chasing 5 years. They have to hold these shares for options for the 5 years, and after 5 years, they can do it. Using the Black-Scholes model, the controller has determined that on January 2nd, 2019, the fair value option was 35 each. He also determined that on December 31st, 20, non-voting share had the estimated fair value $1.50. And the fair value of the options using the Black-Scholes model was 75 cents each. Of all the drivers, 60% selected stock options, 40% selected stock appreciation rights. Jen estimated that only 80% of the driver granted those instruments will be employed by this company 5 years from now. No amount has been recorded in financial statements for those packages. So that will be the one that we have to deal with. We have to do something about this. So let's go now to the page 81. Let's stop here on 81 and let's move to our answer and see where we are on the answer. And see now how we're moving from here. That should be somewhere around 98, page 98. Let's go. Additional information, no. A little bit more. 100. Let's see if we go 100, tax additional information. So this was the beginning of the managerial accounting financial reporting. Let's move to our assurance and let's see where the assurance is. Here, page 118. Okay. So what's happened here? First, we candidate the appropriate accounting for the stock options, stock appreciation rights, and recommends instruments to grant. So what they're dealing with this? They come up with the standards, right? Can you see my screen?
Yeah. No, I
Okay.
can see your screen. I'm also checking mine.
Okay. Yeah, all the things, right? So they come up with the standard. Stock-based compensation and other stock-based options. So they extract from the copy and paste from the standard. Now let's say what's their reasoning. Therefore, because of this, all those things, on January 2nd, when 90, so we're talking about the options here. First, we're talking about options. That means 90 options, 90 people out of 150, 60% issued us. Driver were each granted 1,000 stock options. Since the fair value is 35 cents each, to purchase one common share per option, the transaction should initially be measured of 31,500. So how they get to that? 90 drivers, 1,000 options, fair value 0.35 per option. Now, there's addition in this paragraph that compensation cost to the stock award employee shall be recognized over the period in which the related employee services are rendered, but by the charged compensation costs if the awarded for the full service. Now, she's saying that not all of them is going to have this full service, right? In the absence of the information needed to reduce the compensation expense for any options not to exceed the vest, 31 compensation expense will be recognized in the amount of 6,300 per year. So basically, what we have to do is compensation costs of stock award employee shall be recognized over the period of which related employee services are rendered. So since we're giving them for 5 years, every year we should recognize the same amount. Make sense?
Makes sense.
So now before finalizing the amount, now if you do it up to this point, you're on the RC. No questions about it. Now what's going to be you to see?
Initial recognition.
Right? So if you go here, finalizing the amount to be recorded. Now it's necessary to consider this paragraph. So this paragraph gives you a little bit more. At the grant date, enterprise may choose the base accrual of the compensation cost on the best available estimate of the normal options or the equity instruments that are expected to vest, and to revise that estimate if subsequent information indicates that the actual forfeits are likely to differ from the initial estimates. So do we have a forfeit here? Yes, we do. Why? Because she estimates that only 80% of the options will be exercised. Right? That's right on the case. So for that reason, we can estimate that 20% driver will not stay with the company. So for that reason, we can eliminate the 20% of $6,300, and then we can recognize only $5,040. Right? So ESA could therefore choose to, could it choose this amount, but also can choose to set the full amount and consider the non-vesting rights as they materialize in the future year by downward adjustment for the compensation expenses in equity account. So basically, in the first year, you can go with 6,300, and later years, you can adjust that number to match your expectations. Makes sense?
Makes sense. Yeah.
So that's the one that you have to be adjusted. Now, the question is, big picture. That's a small picture. How we fix the problem? We fix the problem. What's the big picture? How this going to affect the user's financial statements, which is the bank, which concerned with the debt to equity ratio.
It's gonna increase our debt because we owe. Yeah, it's going to stock appreciation.
So let's see. Watch this. Since the option represents equity instruments and do not obligate to pay out any amount of cash, no liability is to be accounted for. Right? This is the option rights. The guy is going to pay us cash. We're not paying any cash. Make sense?
Makes sense.
The offsetting credit is to counter the surplus in the equity account on the balance sheet. Given that the increase in the compensation expense will decrease the shareholders' equity and will offset the credit on the contributed surplus on the equity section, there will be no impact on the debt to equity. So you're flipping an expense and you accumulating that expense as a contributed surplus on the equity section. The expense reduces your income, hit you on the equity, but on the other side, on the equity section, you're adding more equity. So whatever you're taking as an expense, you add it to the equity.
Yeah.
Do you understand this logic?
Yeah.
Eventually, income is going to hit you on the equity, but you already put that the same amount in the equity, so there's no effect. So that's with the stock options. Stock options is not our problem. Let's say with the stock appreciation rights. Now, again, extract for the stock appreciation rights to the driver awarded. Now, this is statement. Then, again, this is from the standard. Award the stock appreciation rights. Call for settlement in cash is an index liability. And the measurement date is the settlement or exercise date because it's consistent with the accounting of similar liability. Now, how many left? Only 60 drivers exercise that one, so 40% out of 150 who selected stock appreciation, right? In recognition of the compensation. The difference between the estimated fair value of the shares and the benchmark shares on the granting date was $0, right? We give them one appreciation rights for $1, which worth on that given date $1. And when the rights were granted, shares were valued at the estimated $1 per share, which is the same as the benchmark. In addition, none of the rights were vested yet. Therefore, there is no expense at the issuance date of the rights. That's it. Now, as of the change in the value of the shares happened in 2019, it must also taken into account to measurement the expenses liability of the 2019 financial statement. So at the end of 2019, we have to check where is now the current value of the shares. And they said on the vesting 1.5. So 50 cents are on money now. Since the shares here end worth 1.50, are now worth 50 cents each, in total of $30,000. Why $30,000? When we get in this calculation of 600 rides, 60 drivers, 60,000 time 50 cents, $30,000. Since 1/5 of the vesting time has elapsed in 2018, the cost of the year will be 6,000. Now, same thing with applying here the idea with the stock options. They can choose to reduce the cost by implementing the 20% forfeit. So they can go and reduce the liability to $4,800. As it would reduce the unfavorable impact. So we're chasing here which amount is lesser, 6,000 or 4,800. Since 4,800 is lesser and we have to show it as a liability now, obviously we're going to choose 4,800 in order not to hit us too much covenants. Now, each reporting date, liability must be reevaluated on the basis. So now, once we do the journal entry, then we're going forward. What we have to do this further. Each year we got to reevaluate on the basis on the intrinsic value of the rights with the corresponding impact on compensation expenses. And cumulative amount equal to the number of years since the grant date is 5 years from now. Now, so every year now, since we have first year increase 50 cents, then the next year that can decrease, can be $1.35. Then we have to reduce the amount. If the next year is $1.40, we have to increase the amount, right? That's the game that we're gonna play. Make sense?
Makes sense.
Okay. As we can see above, the issuance stock appreciation rights has the determining impact on the debt to equity ratio. So what we're using here on this paragraph, we're satisfying only one thing, and that thing is here. Remember, we have to assess the accounting treatment on the stock options and stock out rights. We already assessed that one. And we have to recommend which financial instrument to grant in the future. Right? Since we already identified that we have to do recommendation, we're not going to miss that part. And that's where that part is the recommendation. As can be seen above, the issuance of the stock appreciation rights has impact on the debt to equity ratio, which the stock options don't have. Furthermore, the presence makes the net income more unpredictable as the amount is recorded as an influence by the value of the shares, which can fluctuate. So we recommend, do you see what they say?
Yes, I see what they're saying.
They say we recommend. What you have to say is I recommend or we recommend, whatever you decide to do. If you don't say I recommend, there is no recommendation.
So, okay, so there's a big difference between stock options and stock appreciation.
Right.
Right.
With a huge difference between them. Stock options don't affect the debt to equity. Stock appreciation, they affect the ratio. Not only that, they fluctuate. based on the price of the shares. If the share price of the shares goes up, liability is going to go up. If the
Right.
price of the shares goes down, the liability is going to go down.
Go down.
Right? So the only thing that you have here to play to reduce that liability is the percentage of the employee that you're expecting to stay after 5 years. So after the second year, you may see that out of those 150 employee, which is granted that actually only 60 was granted appreciation, right? 10 of them already left. So what are the chances in the next 3 years, another 10 of them to leave? That's another possibility, but that's going to help you to reduce the liability. However, going forward, if you have to choose between those two, and since you have the bank covenants, obviously choose the stock options. But you have to explicitly say it. Okay? You have to explicitly say, I or we recommend in the future company to use stock options rather than appreciation rights or anything. I mean, whatever you come up with, just make it obvious. In this case, the stock options. But some case, if it's unconclusive, you can go with the, I recommend to use the stock appreciation rights and justify your recommendation. They looking, did the candidate make a recommendation? They don't say, did the candidate make a recommendation for this particular thing? In this case, probably it will be obvious that they're going to look for you to give the recommendation stock options rather than appreciation rights. But they're looking for recommendation. If you say the company should use stock options, that's not recommendation. That's conclusion. You're not going to get the mark for recommendations. So again, keep it in your mind. In order to get the conclusion, you have the conclusion. Now you have to recommend. A recommendation is only and only when you say, I recommend this. And then you put a comma because of this and this and this and this and this. Right? That's the recommendation. Anything else, conclusion. And you're not going to get marks for recommendations.
So,
okay. Yes.
So we're saying on that one, I should put. So are we saying I should put like a heading and say conclusion and then say what I'm recommending for?
Yeah, you can do a recommendation. Yes, conclusion and a recommendation. You can put a subheading: conclusion or recommendation. You can use. So basically, what you can do on your answer, what you can do on your answer, you just follow the format of the question. Assessment first. Assessment of accounting treatment for stock options. Discuss. Assessment of the accounting treatment for stock appreciation rights. Discuss.
And then which to grant in
Right.
the future.
Right.
And then you're answering that.
Right. And the recommendation, which financial statement instrument to be granted in the future. Conclusion or recommendation.
Okay.
Makes sense? We can easily break it by those three parts. Here, first will be assesses the stock options and open a new document, and one subheading will be to assess the accounting treatment of stock options. Then we're going to use this to assess accounting treatment. And then we're going to go to stock appreciation rights. I don't know if you see my screen. I'm flipping from one screen to another. You don't see the screen, but I'll show you now. Let me do this, and I'm going to show you on the new screen what I already have. And that will be your, literally, it's going to be your subheadings on your work. Let me finish it and let's get there. So once you get those things on your work, on your Word document, on SecurePass, that should be the subheadings. And get rid of this 2 assess accounting treatment of the stock options, assess accounting treatment for the stock appreciation rate, recommend on which financial instrument to grant in the future. So now you clearly know what you have to do. Make sense? Now, since the case is not going to be on the computer, it's going to be only in front of you. Instead of doing subheadings or anything else, you can just directly put it here. Once you highlight it on the paper, just put it there. Assess accounting treatment stock options. Assess accounting treatment stock appreciation rate. Recommend on which financial instrument to grant in the future. Then the next thing that we have to do is just get it directly from the case. Audit planning memo to comment on, or comment. Now we're going to flip the words. Comment on audit planning memo. Now that's the next thing that we have to do. Right? Then what we have to do, we have to recommend audit procedures. Then we're going to go audit procedures, recommend audit procedures. On what? For the ESA Ruby financial accounting issue. For ESA Ruby financial reporting issue. And also we have to do recommend to ask you to review the work. Has audited accounts receivable. And the next one is going to be accounts receivable, property, plant, equipment balances review. And now you have your subheadings. Now you have to start create your answer. Make sense?
Makes sense.
Okay, so let's go now to the case. So first assessment opportunity gone. Let's see what else we can get on this case. Let me share my screen. Okay, this one with the sharing. So now, next one is to provide review comments on the audit planning. There you go. That was the second thing that we have to, next thing that we have to audit planning. On the audit planning, again, how are we starting? Risk.
Starting with risk.
Second, materiality. Third, audit approach. So now before we get...
Third is
Yes.
Performance materiality and then approach.
Yes, performance materiality is part of the materiality code, part of materiality, right? You're not separating. Yeah, you can separate in materiality subheading for the overall materiality, performance materiality, and then go to the audit approach. You can do that, right? But that will be subsection of the materiality. So now for this one, we have to go and check what's his memo, because they saying he made some memo. Let me see if that's the case. Audit planning performed by this guy. Right? We move from this assurance let's go to the next one. He doing this. The risk of a material misstatement at the financial statement level is assessed moderate. Okay, that's the first thing. Although Jen extensive business experience and the straightforward nature of the taxi business lower the risk, accounting for the acquisition of Ruby is a complex and increase the risk. This is by Francois, who has no accounting experience whatsoever. Neither knowledge, neither education, nothing. Materiality is calculated of 106,500 or 10% of the loss before income taxes. Okay, on the loss you're gonna get the materiality, good. That's not income though. And audit, and given the moderate risk of the audit, I think that's appropriate. Because this will be the first audit, financial statement, he will gonna adopt a substantive approach for all accounts. That's what he thinks. Let's see what we think. 120. Let's go to 120. Financial. So let's talk about the financial risk. First, we're going to comment on the Francois because that's a starting point. We have to comment on his slide. Francois was correct about Gen business experience, the nature of the taxi business, and the complexity associated with the Ruby. But there are more things. ESA has a different business model than the other one. Those combined with the increased competition with the ride-sharing apps have resulted not be profitable. They might be biased to selecting the accounting treatment most favorable to attract additional investments. So since we're going on the negative side, I can start choosing the account more profitable, which they're doing about the treatment of the acquisition of the Ruby, right? They show it as a cost. So they can, when the dividend comes, they can show it as an income. Even though that's what we want. But they have more benefits if we show it in the equity method, because in the equity method, the income from the is going to increase the when they receive that the other subsidiary get the income, that's going to affect directly this company income, but that's something that they have to deal with. So next one is has subject to the debt to equity requirements, which adding more pressure on the company. Why? Because again, they can be favorable treatment on the accounting policy to satisfy this this requirement, debt to equity. Although, so the other thing is, although Gen in the Agile Investor has indicated their willingness to inject additional money, it's likely that will be preferred to avoid are required to do so. So this is the first year it's audited. So we're having problem with the opening balances, accounting policies, and everything that we have. Right?
Yeah.
This is our first year. Ruby, we already know Ruby. We did audit. but these guys, we never done anything.
Did we do the audit for Ruby, or Ruby is being audited by another company? They have audited financial statements.
Yes, they have the financial statements has been audited, right? Where for us is that's the first time audit.
Yeah. So
So that creates a different problems.
So
we found some accounting errors for the stock options and stock appreciation rights, plus the acquisition of the Ruby,
which is a complex transaction and may have not been accounted for correctly. Yep.
Okay. And since we found two errors, what will be that? They might be additional. Right? So put this in your mind. Once you identify there has been an inappropriate accounting treatment for this and this and this. That's one point. Since we found this, there might be other things that we might haven't seen yet, but we can examine in our audit. And then you come up with some ridiculous things that maybe that's because the accounting staff may be unfamiliar how to account them, which increasing the transaction, which increasing the risk. So you can see how from one thing you can come up with two reasons to increase the risk. You found one mistake, and because of that mistake increased the risk, and maybe because of that mistake, there might be more mistakes which are required, since they have more complex transactions, they might have more problem with that, which will also increase the risk. Now, one thing that I don't, I mean, they right on the top, they're saying about the reduction of the risk, which is the positive. Always try to have some reduction of the risk, some elements that reduce the risk. And once you come up with all those things, you have to revise his statement. He wants the risk to be moderate. We're going to put it as a high.
Okay.
Right? But put this in mind. Since you have a case, and since this case have a problem, the chances the audit risk to be moderate is very low.
Low. I put it at high. My
Yeah,
conclusion
always.
was,
Yeah.
yeah, it's very rare to find it at moderate.
Right.
It's very rare. But in this
Right.
case, because we've seen losses, we've seen so many complex
Yes.
transactions, and it's a new audit,
Yes.
it's gonna be very, and we know already people that are not experienced with accounting, we know definitely it's at high.
Right. Right. So, and the other thing that I want you to have in mind is find at least 3 or 4 of those, and try to find 1 or 2 that are reducing the risk. So, so in that case, you're showing that you're objective. Make sense? That's another quality of the accountant that they're chasing for, you to be objective. I mean, not only to see the negative, I want you to see the positive as well.
Okay.
Right? Keep that in mind, please.
Okay.
On the audit, when you're assessing the financial level of risk. Now, the materiality. We're going to comment about, so first, from where, again, first thing is from where the materiality come from. Materiality, planning performance, risk misstatement, Francois is wrong about linking materiality to his assessment of the risk materiality misstatement. Instead, this standard require materiality to be determined based on this. So we going from the standard first and trying the standard. Then identifying which are the users of the statements, because those are the ones who will be impacted by the materiality. So therefore, the bank will be, so Jen, who's going to be the users of the financial statements? Materiality will be determined based on the needs of the financial statement users. First users is Jen. We'll use the financial statements to assess the performance and determine where to proceed with step 3. Second one, bank, that will rely on the financial statement, which will be audited, to assess the ability to repay and its compliance with the debt to equity requirements. In such, will be interested in net income, loss, debt, and equity balances. The silent angel is the other one who will be interested to see the financial statements because he expects cumulative dividend. The last one will be the drivers. Why? Because now they have a stock options and stock appreciation rights. So they also will be interested in financial statement to see where is the value of their shares, Now, because of the user needs, so once you identify the users, then you moving to the next one. User needs chooses the benchmark, income before taxes. Francois choosing that, which to calculate materiality will have to be appropriate if has no incur a loss before taxes for year ended. As a result, it will be necessary to choose another benchmark. What will be the benchmark? Revenue.
Not the assets.
No, go with the revenue. Listen, if you go with the assets are steady. Assets are steady. Revenue is the one who can show you is the company actually progressing or not. Because I can see revenue increasing. Try to find a positive number. Try to find a positive number. And based on that positive number, which will be, if it's not net income, then go with the revenue. Assets is the very last. Why? Because on the assets, you have a lot of accounting policy, accounting treatments there. Make sense? On the account in the assets, you have a lot of accounting manipulations. You have the
Okay.
amortization, you have depreciation. Which one to amount? Should I value it at the cost? Should I value it at net present value? Net book value, which one to use for the assets? You have
Okay.
allowance for doubtful accounts there. You have lower or net realizable for the inventory if there's inventory. So there's a lot of questions there, a lot of judgment. Revenue is revenue. The only thing that we can have is deferred revenue or incorrect recorded revenue. But even not recorded revenue, the revenue is kind of solid kind of ground to base your materiality.
Okay.
So
Perfect.
now once you have the users, which are the most sensitive user? It means sensitive means who will be more reacting on the small mistake of all those users. You have Jen, you have Bank, you have Angel, and you have what else you have? We have the drivers. Out of those, which is the most sensitive on the small mistake on the financial statements? I would say the drivers. Why? Why? Because the small fluctuation, it can affect their stock appreciation or the share price. So they will be the most sensitive. So once we come up with the range, 0.5 to 2%, typical range for materiality based on the revenue is 0.5 to 2%. Considering the user sensitivity, I would choose 0.5. Honestly, if you ask me, I would choose 0.7.
0.7?
Oh yeah, you can choose 0.8. Nobody can tell you what to choose. Just choose something.
I mean, okay.
Right?
Yeah. Okay.
So don't choose the highest one. Don't choose the lowest one. Go with 0.7, 0.8.
Okay.
Why not? You're the one who's assessing this situation. Everything will be correct. In addition, calculating the materiality, we require external audit, calculate performance. Now we're going for the performance or materiality, which Francois didn't do it. So explanation. Why we need that materiality, which is said that auditor to reduce the likelihood of uncorrected and underdetected misstatement of the classes transactions. So usually the standard says professional engagement guide, make sure you quoting these sources. So that means you have to memorize those one. Okay.
Okay.
So suggesting 60 to 85, they come up with 60. If I were you, I'm going to come with 65 or even go with 70%. Why not? If you go with 70%, this number is going to be even lower than 33,600. Audit approach. On the audit approach, the fact that the external audit will be auditing the financial statement for the first time is not sufficient justification to adopt a substantive audit approach. Rather, the audit approach should be based on the assessment of the internal control, which internal control is high. Given that the quality control team has audited and found no deficiency regarding internal control, indeed intended to mitigate the significant risk related to operation, will appear that has adequate control. In addition to the audit, those who need to perform work with the. So you see how they're using the case facts to come up with the statement about the. So I want you to start doing the same thing. When you see something on the case, how can I use it, and where I can use it? In addition, auditor will need to perform the work to opening balances. Why? Because we haven't been there in the beginning. We are here at the end. I can confirm the beginning balance, the ending balance by physically counting the ending balance and be present on the counting date. But how I'm going to get the opening balance? Working backwards. You know that, right? I'm going to get all the documentation during the period. It's going to figure out debit and credits and going to come up with the ending balance, beginning balance. Since I'm certain on the ending balance, for the documentation, I'm going to see the debits. from the other documentation requisition form, I'm gonna see the credits, and I can easily come up with the beginning balance. So, which would typically be a difficult account balance. So given that has no inventory, auditor should be able to obtain sufficient appropriate audit evidence for balance sheet accounts. Cash can be easily confirmed through the bank confirmation. A property, plant, and equipment can be verified through the account and rollback procedures. So on the rollback means show me the addition of that coming, show me the documents, show me the one going out, show me the documentation, come up with the beginning balance. However, if for any reason auditor is unable to obtain sufficient audit evidence for certain opening balances, this may lead to modified audit opinion. So our concern is not ending balance, our concern is opening
The
balance.
opening,
Right?
because we want to see if we can rely on those as
Right,
well.
right. So, but one thing I want you to see now on the audit approach, up to here, you're saying it would appear that adequate control and combined approach would be more appropriate. So you're advising here to combine approach.
How?
Right?
Why are we using a combined approach when we are supposed to use a substantive? Because like we are not even so sure if the controls are in place. This is our first time audit. Like,
Right.
wouldn't it make more sense that next year then we can say, okay, we've done this audit before. We are aware of certain things, so we can use combined approach in certain areas, but then certain areas we're gonna use substantive approach. I don't know, but I feel I concluded and said I'm gonna use substantive.
But but combine also include the substantive, isn't it?
Yeah, but then combined has an element of there are some areas you're gonna rely on the financial on the controls. But what I'm saying is that I don't think, since it's our first time audit and we don't even know if processes have adequate controls in place, wouldn't it make more sense to just say we are gonna use the substance? We are not gonna rely, since it's a first time audit, we are not going to rely on the
Maybe because they're
the
saying this quality control team has audited and found no deficiency.
yeah, so like that's what I'm a bit also confused about, because the case is clearly telling us that there's an internal auditor that exists, right?
Right.
But which is the QCT. But
Yes.
this QC team is made out of people that are not even qualified. That's even the problem, because when they ask us that last assurance question and saying, can you tell us if we can rely on the internal audit, if the auditor can rely on the internal auditors, whatnot, like scrutinize the quality control team. You notice also they will say you cannot, because objectivity is already out. Pretty much all the three criteria that help to meet uh an active quality control team is already out, because we have inexperienced people. These people are not qualified as they should
Right.
be. We have people with bachelor in sciences, which doesn't make
Right.
sense.
Right. Doesn't make sense. No, not definitely. But the leading team of the audit team, he's CPA and internal audit, certified internal audit. And you have you on the board, which is also you are also CPA.
Okay, so
So for
maybe
that reason, we can, to some extent, we can rely on that. Even though the other people, maybe there's good on technical stuff, but we're relying that the audit, the main person who leading the team is the CPA, and he's also have the certificate for the internal audit.
okay.
That might be the only thing that but my point is, so you see, the audit approach is discussed only in this paragraph. So then why we need this paragraph for? That will be the one who's going to bring you to C.
Wait. In addition, editors will have opening. Okay, yeah. The issue of
Right.
opening balances on their own.
Right.
Evidence.
So this is something that is extra. Makes sense?
Okay.
That give you the higher level. That show you that, hey, this person is actually looking forward proactively to something more.
Okay, so do they also mention Ruby in this case? That
Yes,
we're
they
all
do. Yeah, they did, but we're gonna go
in
to Ruby a little bit later, not right now. We
okay.
only chasing at this point. We're chasing only this. What was that requirement? Let's see. We're working on this on the memo that the person. Let me share my screen. We're chasing only on the. So first we recommended the financial. No, the comment on the audit planning memo. That's what we're doing. Nothing more, nothing less. That's where we are right
Okay.
now. Now we're gonna go now to recommend the audit procedure for the financial reporting issue for both companies, but that will be the
Okay.
second part, not yet. So, right now we're focusing on the memo which was given to us on this page. The only memo that we have, the only part of the memo is on page what was that? 81. This memo here. That's it. We comment on this. Now the next thing is we to go, and now we have to do can you see my screen? What you look? Let me see what you're seeing. Yes, you're seeing the same thing that I'm seeing. That's good. Let's move now to page 121. Let's say. So we're done with this. Let's go with the next one on the. That was the financial risk. That was this. Let's go now to the next one, which is the recommend audit procedures for the financial reporting issues. So tax licenses, the first one, right? Remember those?
Tax license. Yes, the tax license.
Right. So those are the one that we identify here in the Word document. What was that document here? So we have to comment on the tax licenses, on the acquisition of Ruby, and we have to explain about the lease and convertible debt. Those are the four things that we're chasing here. So the tax licenses. So now look how they're starting. Read the media coverage. So get a little bit more information for yourself. Go to the source of the information first.
Yeah.
Read the media coverage, legislation, administrative policy pertaining to right sharing in the board to develop understanding of potential impact of the fair value of the driving licenses. Discuss the tax industry association impact, the right sharing in there. Second, now evaluate the management projection. So now once you get the idea about the industry, start questioning everything what these guys did. Projections.
Yeah.
How they come up with this. Then the next one, discuss the management, any changes of operating during the period of the projections. Assess the reasonability of the assumptions. And the last one is do it again. They did comparison with the carrying amount of the business licenses. You recalculate it again. Reperform the comparison of the carrying amount of the taxi licenses with the total undiscounted future cash flow to be generated from the tax licenses. Now the question here is why we're doing this, and we're doing it for only one reason. We to realize, do I need to solve the financial reporting issue with the tax licenses in order to get this assessment opportunity?
Yeah.
Yes or no? At this point,
Not really. You can just
not really.
also just but my question is no, not really. No, you don't
No,
actually because it's impairment, right? And we've already been given whatever management has said, okay, these are our figures.
right. But we're
And
not
we can just
questioning here the impairment. We're
We are
questioning
not?
no, we're not questioning. We're questioning how did they get that information?
Yes. Okay. So, all right.
And if the information is correct.
Okay, let me just show. Give me 1 second.
Yeah.
See what I wrote that for risk, I wrote risk that the taxi license is impaired and managed due to the following reasons. Management has not incorporated the impairment due to high management bias, as this will weaken the financial statement, therefore increasing the risk of material misstatement at OFSL. And then I said for procedure, I just said obtain the cash flow statements and assess management's calculations in regards to cash flow figures and assess for reasonability. And then I just said recalculate and compare figures to management's figures and assess for reasonability. That's all I said.
Okay. So the other thing, one more thing now. So start getting the basic one. So you're getting the recalculating, you're getting the idea about going through the assumptions. Now get the first one. Understand the situation.
Okay.
Right? So which is here. Read the media coverage, legislation, familiarize yourself with the situation to understand a little bit more about what's happened with that environment.
So you want to get external information about what is causing.
Exactly. And as we're gonna progress here, I expect to see the same pattern each of those things. First, we're gonna get understanding about the situation, and after that, we're gonna questioning what they did. And the last thing is we're gonna recalculate if it's possible. Right?
Okay. Yeah, right.
So try to start to follow this pattern. We can see it in this case. Now we have to chase another case to see in the other case when they're talking about the audit procedure, do they follow the same pattern?
Okay.
Right? And then we're going to have, okay, now for every time when they have the audit procedures, first, if it's in the area that I have no expertise, get the expertise.
Okay. Yeah. Okay.
Familiarize yourself what you're going to chase, everything that's possible, documents, media coverage, legislation, anything, right? So let's see investment in Ruby. First, again, familiarize yourself with the what's that? The original documents. What will be the arrangement of the purchase?
Purchase, yeah, and see if
Purchase
there's
price. Check the purchase price. Develop understanding of the purchase and ensure the existence of the investment. Is it actually that investment with that price actually exists? Then start questioning the person who did evaluation, right? To comfort yourself with the fact that this is actually a fair market value price, right? And then question the expertise. Is this independent? Is actually have the designation and knowledge to be qualified to do that. So here, review the valuation report. Obviously, the discount rate will be important because it's a long projection. Any unrealistic discounted rate is going to affect that projection. And the other thing is start questioning the qualification of the independent appraisal, which is ridiculous. And it's common sense. But since you don't see that they're using it, you're never going to come to that idea on the exam. So now you can easily add this one there. Every time when you see qualified independent appraisal, there you go. Question it right away. Every time when you see estimates, question them right away. Is this the right one? We're going to find additional information. Is this the right one? Is it in the line of this? Is it in the line of that? Can you come up easily with those one now? Hello?
Very, yeah.
Yeah.
No, sorry, I'm reading.
No. Yeah. I want you to realize how easy you can get those ones.
Yeah. Yeah.
And the last one in the investment is fix the problem. What is that? Obviously, the 250 has to be added in the investment account and recognized as investment income, and the dividend has to go to the
investment account and reduce
right.
the
So,
value.
but look at the dividend. What else we're gonna chase?
Support that we got the
Yes,
dividend.
right.
Bank information
Is there anything on the minutes?
that shows that yes, we got. Oh,
There's
yeah.
a meeting of the owner, meeting of the principals, the owner directors of the company, and they actually decide to declare dividend. And what's the declaration date? What's the payment date? You can even go further here. Is the dividend actually paid? So next one, the leases. Same thing. Look at this. Look at the idea. Review the lease agreement, right? Understand the term and conditions. So familiarize yourself with the facts first. Then start questioning the numbers that they throw you. How they come up with the $5,000 purchase price at the end of the lease. Is this actually realistic? Can we compare it with the resale value of the auction house and whatever website or the dealership? Come up with some crazy ideas.
Yeah.
Right? Examine statistics about the useful life. So now I'm going to question also the useful life. How they come up with the 10 years useful life? How you come up with the 7 years useful life? Based on what? So how are we going to get statistic of the dealership that sells used car, the taxi industry? Assess the reasonability of the interest rate used to calculate the present value, because we have to come with the present value of those guys. Lease payments. How did you come up with this? Is that the incremental borrow rate? What exactly is used for the interest rate? And the last one is redo the calculation.
Okay, sounds good.
Right? Convertible debt, same approach. Review the documentation, right?
For convertible futures, just to
Right?
see that yes, it is actually in a convertible debt.
Right. Then, so since it's recommended it was made the instrument of the debt to equity comprise, assess the reasonability of the interest rate. Comparing the interest, and then redo the calculation again. Stock compensation packages, same approach. First, go to the source, find more information, familiarize yourself, figure out, is there minutes about this? How they come up with those compensation package? Who approve it? Then on those one, you have a lot of questions. Why? Because everything, you have evaluator, black shoe model, this thing, they come up with how did you come up with the fair value? What's the supporting documents that that you have the share price on the granting date? Exactly that one. How do you come up with this? Then yes, the black shoe model, the black shoe model, exercise price, risk rate. So the black shoe model, now obviously you have to have more understanding about the finance in order to question the black shoe model, because in the black shoe model you're using this risk-free rate of the treasury. So you're gonna start using the question the calculation. Did you use this? How you use it? How did you get the volatility? How and then once you do that, you're gonna recalculate it to make sure that everything is correct of the accuracy of the token compensation expense. Then you're gonna go to obtain the human resource records about the number. You remember only we expecting 20% not to be in the company by 5 years. So now what we're gonna do? Or I'm giving the options to the 150 people. Give me the records that those people are actually in the company. Make sense?
Makes sense.
Right? And then you redo the calculation again. at the end. So basically, you see, we're following the pretty much the same pattern.
Okay. Yeah.
Find it from where did it come from, what do I know about it, can I justify it, then go a little bit further, one after another, logically go follow the structure of the information that they give you. So that's with that one. Next one is we have to review and comment on the audit work performed by Francois on the accounts receivables and property, plant, and equipment. So let's go and see what he did in this accounts receivable, property, plant, and equipment. I'm guessing here that's too much. Let's go back. Here, what he did here. Accounts receivables. For December, from December 31st to December, accounts receivable decreased by approximately 1%. Since this decrease is immaterial, work was limited to agreeing the total accounts receivable balance per the H subledger to the financial statements. That's how he did. Next thing. On the property, plant, and equipment, we can see everything here. Balance agreed to the capital asset continuous schedule. Purchase price of the new vehicle totally. So we have a purchase of the new vehicle. So we have to confirm, is this actually approved by the management? Who would get it? Where's the documentation for that one? You know, you're working on it, right?
Yeah.
So every time when you see purchase, give me the documentation. Everything is over certain amount of time, a certain amount, over high amount. Give me the at least proposals. How did you choose this one? Who choose it? Based on what you choose it. Management only addition was the new desk of Jen. Since the amount is immaterial, no further work considered necessary. Per management, what's the office equipment is cost? New desk is 12,000. Okay, but based on our, that might be material, right? Based on our material. Per management, no addition further work considered necessary. Acquisition depreciation recalculated. Error not noted. Footed, cross-footed. Okay, that's footed and cross-footed. That's something that you are familiar with. So now let's go to the answer back and see what's happening there. Financial statements issues. We're done with those one. Let's go to the accounts receivables and property, plant, and equipment. So first, accounts receivables. There are many deficiencies. General, given that it's material, Francois has not gathered sufficient appropriate audit evidence for the accounts receivable balances. Why is material? Because that's how we set up the materiality. The fact that it has decreased by 1% of the period is not a valid reason not to perform work on the balances. So first you're questioning what he did. Thus basically this is case facts, flip it here, and questioning everything. So Francois should have footed the aging accounts receivable listing and compared the sample of the balances of the account receivable subledger. So basically, we try to trace is the accounts receivables actually exist. To ensure the accuracy of the accounting data, in addition, accounts receivables aging in the subledger should be tested on the sample to determine the number of the days owing. Since this is an audit, the audit procedures are very, very straightforward. You sending the confirmation letter, they are sending you back directly to you, not to the company. And you obtaining on the select sample, you try to make it see the existence and verification of the balances. Should have confirmed a sample of the outstanding balances with the drivers to existence of the accounts receivables. Additional, Francois should have tested the subsequent receipts Selecting example outstanding accounts receivable from the subject, tracing the subsequent. So basically what I'm doing is you doing this in audit. You're not chasing only the account balance in the last month of the year. You're chasing the bank balance on the first month. And then you're trying to find, is there any payment which are from the accounts receivables at the year end? Correct?
Correct.
So that's how you're chasing those sample the subsequent receipts. Then it doesn't say here, but you definitely should have allowance for doubtful accounts, right? And yes, he's seeing that the accounts receivable increase only with decrease with 1%, and difference is only 1%. But that might be because I have a super high allowance for doubtful accounts, and in the balance sheet you see accounts receivables. You not see accounts receivable less allowance for doubtful accounts. Right?
So in this case, I don't even have to be mentioning like the risk and everything. I just have to just be stating procedures to do of what
Yes,
to do, right?
that's what they're asking, right? In this case, that's what they're asking. Stay with the requirements. Don't go further from the requirements. The requirements clearly stay. Accounts receivables, equipment balances, recommend audit procedures. That's it. No risk, nothing. Audit procedures. We're focusing only on the audit procedures, nothing else. I want you, that's why it's very important you to read the case and you to read the requirements and understand what exactly you have to do. So that's why, again, I strongly suggest you, once you step in the exam, first read the start of the case and then go and read your requirements so you can understand what do you need to do. And then start chasing because so far up to this point, we don't need to solve any of the financial reporting and managerial accounting problems. Are we?
Yeah.
We don't. None of those gonna affect our whatever we're writing here. The only thing that they can see is here for the what was that? For the acquisition of rubies. That's the only investment in ruby. But that's a common sense. You don't need financial to fix it on the financial statements before you comment on this on the assurance. That's something that you can just pop up in your head right away. So let's see. The other thing is here on the allowance for doubtful accounts. Make sure that exists. It doesn't say anything about the allowance for accounts, so that will be extra. But just have it in mind. Naturally, accounts receivable goes with the allowance for doubtful accounts, regardless if it says or not. Like same thing, like assets goes always with the depreciation account. They always go together. Now the balances, this is a very interesting thing here. The balances accounts receivables has only decreased approximately 1%, but revenue increased with 13%. So there's something wrong here. This means that the accounts receivable balances is not complete. Francois should discuss with the Jen the possible reason for the accounts receivable balance being similar to the last year. Because again, if we look at this, what was that page 81, I believe, additional information, this one, what's this? My revenue from 10 goes to 11, but my accounts receivables goes down. They should follow the same pattern. Unless I did something, which I don't know what I did, but it has to be something phenomenal. Anyway, so the property planning equipment, through his work on the property, Francois appears to have relied exclusively on the management representation and evidence provided by the management. As a result, it's questionable whether the sufficient appropriate audit evidence have been gathered. So what we have to do, after footing and crossing and cross-footing the cost, so once we confirm that the cost is actually cost and it's recorded, accumulated depreciation, net book value columns on the working paper should have agreed the balances on the general ledger account to the financial statement balances in the note to ensure the accuracy. Then the purchase of the new vehicle should have been agreed with the original prices rather than conformally discussed with the managers. So given that the average purchase price of the two vehicle appears to have $100,000, we have to have evidence on the purchase price of the vehicle, and so the team have to provide information about the contract, I guess, increase the concern additional vehicle, we purchase additional licenses and anything with those one. Now, regarding the office equipment, although the increase is less than the materiality, it may have been appropriate agree additional to original purchase documentation.
Jesus, I think we had this one last year.
Yeah.
We had this exactly. Yes, we did. We did. Oh my god, I remember seeing it, and I was like, because I didn't really go through this case because I found it hard. However, like I did pass assurance on my first
Right.
trial, but it came. This footing situation came as it is, and I panicked. I remember panicking when I saw it, and I'm like, oh my god. And then I just wrote whatever I thought came to my mind,
No,
and I kept.
listen, it's the first thing is don't panic,
Yeah,
right?
sure. If
The
you
first thing,
panic, everything goes out of the
go away.
window.
Yeah, yeah. The worst case scenario, you don't know what to do. Fine. That's totally fine. But as you can see from every case that we're going so far, the requirements are
Mhm.
linked to the case facts.
Yeah.
So draw the case facts related to
Mhm.
that requirement and
Mhm.
stay with that area. Nothing more, nothing less. Try to use your mind to see you have enough experience to come up with the ideas what kind of audit procedures to put here,
Mhm.
right? That's another thing that I want you to start developing, and not to panicking, rather than what else I can do, what else I can do. And as you can see, some of those suggestions and the answers that they're giving us very logical and very basic.
Mhm.
Sometimes you think, really, that's what you're showing me as an answer?
Mm.
Are you kidding me? That looks very simple, but because we're usually thinking of something extraordinary and we're trying to impress them, we're forgetting the small things that we can add. Be practical rather than going beyond. Make sense? Try to
Makes
stay
sense.
on the planet Earth. Don't fly in the sky. Fix the problem. You have a problem, fix it. They're asking for specific things, give them specific things.
Okay.
Right?
Yeah.
Make sure the assets are there. Show me the documentations. Management, you getting all the information from the management. You rely on the management. Nobody relies on management. Give me the
Management.
give me the documentations. I want to see the contracts. I want to see the purchase price. Show me that purchase price has been paid. Show me the documentation that you have the receipts, bank transfers, everything. Right? Then do the some of the registration documents. You have licenses, you have this on the vehicles, you have meters. I want to see those meters that's installed in the vehicle. You may tell me I have 150 meters, but those cars running only 130. Show me that every car has a meter,
Yeah.
right?
Mm-hmm.
That's easy. You haven't at the end of the year. Did you make sure that those cars are actually exist? No. Did you count the cars? That the 150 cars? No. Can you do
No.
it? Absolutely. Go and perform that. Right? Those are common sense things which you as an auditor you already know that.
Mm-hmm.
So, is this vehicle need a license? They need a license. Did they need the insurance? They need the insurance. Show me the documentations that they have insurance policy. Right? All the things. Everything is here. Francois, recalculate accumulate depreciation. You have depreciation. Show me the calculation. Give me the original documents. How you chasing this? How you chasing that? Francois have discussed the estimate useful life. The management determined whether the factors of the technological advance, those are the, how did you come up with those idea that there will be the like a impairment or anything or useful life? How did you come up with the estimate on the useful life? Show me your calculations. Does not to perform the impairment procedures. Francois should have discussed the management review and the relevant documentations on the minutes, and everything should also inspect the assets whether they determine whether there is insight of solvency, right? What if one of the car is hit 3 times in half this and you still driving it? I want to see, is there any assets which are obsolvent, which are due to be write off? Are all the cars in the good conditions? You can come up with this very easy. But you have to open your mind and think about this, right? But that's going to come with going over the cases and seeing how ridiculous answer they're throwing you, and you're just missing it. So next one is the candidate driver may be not paying the royalties and all. So let's see first from where that one comes from. So we have to go 125 somewhere. No, more. Less, sorry. Let me go to page, let's say 95. That's performance management. We don't need this one. That's crazy. Let's go to our assurance. On the assurance, we have on the tax, we're done with this. So this is what's left for us. Approximately 80% of the all trips are arranged through the Rubies. So we're talking about the Ruby stuff. Dispatch center, and 20% the resulting passenger hailing taxes. Passenger can pay their fares by cash or credit card.
Oh, so we're doing WIR?
Sorry?
Was this the WIR?
What do you mean?
Weakness, implication, and recommendation. Is it the one about the taxi royalty?
No, yes,
process?
It's the taxi row, but our requirement here is, let's see what's our requirement here. Our requirement on this one is we to management, because the Ruby driver use their own meters, because of that, concerned if they might not pay the full amount of royalties. Ask you to explain how this might happen, and discuss what the internal control will ensure that Ruby received all the royalties. So first we're chasing might not be paying the full amount or royalties on, how this can happen. Right? And after that to discuss what we have to do in the internal control. So let's see what they're saying here. First, the case facts. They having cash, credit cards. Driver contracted by Ruby, provided their own meters to track fares. Because Ruby does not require specific model, considerable variety of meters are used. A small numbers driver have meters that print receipts. Now, the small numbers print receipts automatically while also transmitting electronic records to Ruby. Most of the Ruby drivers have basic meters that only determine the fare to be charged. Those drivers use handwritten receipts that they'll fill out with the date, pickup and drop-off point, rate, fare, GST registration number. Receipts are only provided when they're requested by passenger. So if the passenger say, forget about it, I don't give you the receipt. Whether or not the receipt is issued, the driver note on the trip of the paper log that's the annual, what's the amount of the fare, revenue can be tracked. So many opportunities here I not to record my the money that I get from my passenger. So many opportunities here. Right? Regardless of the type of the meter used, driver required to pay 7.5 royalty revenue to Rubies every Sunday. On the weekly basis, Ruby accountant calculates the royalty and on the weekly basis.
That's too long of a time to recognize revenue.
Right.
Do it on a daily.
Right. Reconcile the payments received, and driver required to reimburse Ruby for any shortfalls. Ruby allows the driver to submit royalty revenue by cash or check delivered to Ruby's office or by electronic fund transfer. Because the bank fee involved, few drivers pay electronic fund transfer. Other than late remittances, Ruby has not encountered any difficulty with the royalty revenue paid in cash. Obviously, paid in cash will be the easiest one. However, several of the checks written by the driver have not cleared by the bank due to the insufficient funds. So we have problem with this.
Yeah.
Right. Additionally, Ruby's accountant does not have time to follow up of the outstanding amount. That's another problem here. As a result, there has been several instances in which remittances have been late or have not been made prior to the drivers leaving Ruby's, necessitating the writing of the royalty receivable. So basically here, every sentence is a problem. Every sentence is a problem, right?
Yeah.
So you can easily draw a lot of stuff from here, easily.
Yeah.
So let's see what they come up with. Drivers with manual. So now we separated with manual, Ruby the business model, which driver. So we explain first the business model requires 7. That's the case facts first, and then we go with drivers with manual. They could not use the meter for all the trips, accept payment, and not record in the log. Use the meter, accept payment, and not record the log. Record the trip on the trip log, but write down the amount lower than the actual fare, and make unintentional error while recording the trip on the trip log. So those are all the possibility that can happen. You can come up with even more. So what's the internal control? So first are what they ask first. They first to identify, to explain how they can do that. So we explain how they can do it. Once we know what they can do, what we can do not to do it. So Ruby should investigate whether it's possible to modify the meter receipt automatically printed in record, the fare transmitted directly to the again cash register or anything. If modifying meter is not possible, there should be a system in place to ensure the receipts are issued for every trip, and so on and so on. So you can see here how many interesting things they're coming with. Receipt should be included in a link to passenger satisfaction survey. Passengers should be provided with the incentive to complete the survey. So you see what kind of crazy ideas you can come up with. You can easily come up with create an app when the passenger during the driving with the taxi instantly have access to the app, and he rating the driver, and he's satisfied with the driver. He comment on how much he paid, is the fair, and everything like that. And then you should be perform a reasonability analysis by calculating the royalty revenue related to the trip, orange, to the Ruby's dispatch center based on the number of the trip, average distance, and fare. And Ruby can also compare each individual driver remittances per hour work for the company average. And then can give you the output. Additional following would be required. There are some steps that can be taken to address the concern with the completeness of Ruby royalty revenue. If decisions are made to proceed to step 3, you should ensure that when the new meter need to be purchased, they are purchased by EC, including the fare future recommended above to reduce the risk of the royalty. So this is going forward, right? Once we implement those internal procedures, going forward, if you implement those one, then you can reduce the risk of the incomplete royalties. So now we're going with the drivers with the automated meters. For the driver that have meters that print receipt automatically and the transmit fed the details to the Ruby electronically, the risk is of underreported revenue royalties is reduced. However, the meter could be possibly disabled, such as not all the trips are transmitted. Trips are transmitted. They are allowing the driver to pocket the full fare and not remit the required royalty to Ruby. So we come up with something common from the country that I'm coming from. Yes, my meter is always working, except they cannot make connection with the internet, which happen almost all the time. Right? I'm gonna put something, you know, there's a devices that interrupt the signal and everything like this. And every time when you want to do the audit, I'm gonna remove that device. You see the meter transmitting, everything's fine, all the trips are recorded. Well, this day you have only 3 trips. Well, it was a very slow day. The other thing you can do is you put the GPS on the. You can go with the idea. Put the GPS on the cars, and you know exactly the trips. But the dispatch log figure out how many trips they have, and you can get it approximately. So all the internal control suggested under the manual meters would be also effective here. In addition, now you're going with the secret shoppers, right?
Right, yeah.
Not to engage the meter and determine whether the drivers are doing this. Now check, the next thing is check from the drivers. We're having problem with the check with the drivers. If they don't do that, so ask them to use electronic fund transfer or e-transfer. Now we can use the e-transfer. E-transfer is more practical. Or to give you the certified checks. Alternatively, could require the initial deposit from the driver who wants to pay by check, which is held by Ruby and could cover the instances of insufficient funds. That's another thing. Accounts receivable follow-up with the guy who not doing anything on the accounts receivables. First, you're showing the impact, discuss the impact, and then showing the internal control procedures. As you can see, they're very short on the procedures. That's one opportunity for you to add a little bit more here. You can easily come up with the new procedures. Since Ruby Accountant does not have time to pursue outstanding accounts for non-payment, you should consider adding a new accountant. That's usually is not very advisable suggestion, but in this case, since it's the standard, just throw it away. Because the argument can be you increasing the cost for the company, which already losing money. Makes sense? In this reality, it's not the best suggestion here, but it is suggestion. And Ruby could consider implementing penalties for the driver who account receivables are overdue, such as remove their access to dispatch calls. Also, Ruby can encourage those drivers by giving them some, I don't know, not discount, but some incentives just to pay on time. You can come up with this to give them some incentive on the drivers who are not paying. Don't say discount. Don't say discount, because if you say discount, then they're gonna the other drivers also gonna start looking for discount. Those guys, they're talking between each other all the time, right? So those are the possible improvements in the internal control that should be in place. So you can see you're discussing may not be paying the full amount, from where the damage is coming, and what can we do to limit those damages. That's what we're doing here, nothing more, nothing less. And you can see different type of answers. Here you have a bullet point, and here you have the paragraph point, which again explain the situation and tells you what the problem is, and then how to fix the problem. Next one is the candidate describe the procedures that the external auditor will perform to satisfy the requirement for the airport contract. So for that airport contract, we have to go and see what the contract is about. Let's see if I get this contract right away. Should be here somewhere. Here the contract. So the contract, at the end of the first year of the contract, each successful bidder must submit to the Calgary Airport an audit level attest and engagement to report on the compliance report from the independent auditor, attesting to the company's compliance with the following performance measures. We have first, minimum 20 taxis from the company are present at the airport between 6 and midnight. The company charges passenger agree upon fare. All the vehicles are insured against the property and casualty losses with the liability coverage passengers incurred no less than 5 million per occurrence. All vehicles pass 100-point safety inspection on the quarterly basis. No more than 5% of the trip result in the passenger compliance regarding the vehicle conditions, the way the drivers conduct forward towards the passengers. So that's what we have to do. So we have to have this report, which attesting that the company complies with all those 1, 2, 3, 4, 5 things. So how are we going to approach this? First, we have to establish which is the report. We already know which report we have to use, right? They explicitly say a test and engagement report.
And then we see if it what are the procedures related to the report.
Yeah, then we have to come up with any procedures which actually confirm what the report asking. So let's go to the requirements and see what exactly the requirements were on this one. So let me share this Word document that we initially start with. So here, managers is eager to prepare Calgary Airport contract should ECA is done successful bidder. Therefore, just ask you to draft a memo to the management describing the procedures an external auditor will perform in order to provide the report required. So what kind of procedure this external auditor will perform to provide the report? That's where we are.
So what does
yep.
What does we start with what Calgary Authority wants out of that report, and then we see the kind of reports that are available to meet that kind of assurance that they want, the level of assurance that they require.
Right. So basically, we just chasing those. What exactly this auditor will do to make sure that these things are met. Which things? The one that they want. What they want. They want to have a minimum. So basically what you're going to start is should successful bidder the contract, the report from independent auditor supporting the company statement compliance with the performance. In order to external auditor to do so, the following procedure could be performed. What the external auditor will do. So basically, tell me what the auditor will do, so I'll make sure that I'm doing those things that he's gonna check in order to tell the authority that I'm actually complying with the contract. Make sense?
Makes sense.
So you tell me what the other guy is gonna do, so I can make sure that I'm doing exactly the things that he's gonna check to make sure that I'm fine with the contract. That's all. So now you have to come up with the idea what the other guy is going to do, what kind of procedures they're going to do to confirm that this actually is there. So first, how they going to confirm that the minimum 20 taxi must be located? The first, so basically here you copy and paste from the case. Minimum 20 taxi must be located in the airport premises from 6 to midnight. And then what the other guy is going to do? Well, he can make unannounced visits to the airport, count the number of the taxis at the airport to ensure the company has the required number. Also, he can check the dispatch logs for the available or the sample on a sample basis to ensure the correct number of the taxis at the airport. You don't have to go crazy here. Oops, you can see they going with one, sometimes with two of those. Next one, company must charge passenger agree upon fee. Well, what I'm gonna do, I'm gonna check the receipts. Electronic record from the computer assisted audit techniques to identify the exception of the agree upon fare. In order for this procedure to be effective, it will be necessary to receipt to be itemized on the fare versus tip. The other thing that what I can do is, again, put those secret passengers. So to make sure that I'm charged the correct fee. All the vehicle must be insured against the property cat. Well, go and check the insurance company. External auditor will request copy of the insurance company directly from the insurers. Then it's going to go with the schedule, with the cars, which cars, how much is the coverage, everything. Insurance company is going to give him everything, right? All the vehicles must pass 100% 100-point safety inspection quarterly basis. So what the external auditor is going to do? He's going to go and check the maintenance of the car. He's going to examine the car. He's going to examine probably he's going to go to the, I don't know, mechanic and hire the mechanic or hire somebody to make sure that these cars, he's going to give his independent opinion that those cars are actually 100% passing this inspection. And from the quarterly report from the place that I'm putting those cars to sign the report, I'm going to ask for the documentation that they're actually passing that, have a proof for the inspection and for checks, everything. No more than 5% of the trip can result passenger compliance regarding. Here you have so many options. External auditor, what he's going to do? He's going to go and check Google. He's going to go and check Yep. What I'm chasing, negative reports. Right? That's how I'm going to get those 5% trip can result in, no more than 5% can result in negative. I'm going to put a secret people to go there, figure out what to do. There's so many options here. Look at this. External audit can obtain management records, number airport trips, assess reasonability number based on the surprises. External audit can obtain the record of the number of complaints regarding the vehicle conditions, matter from where. I can even call the police and they're gonna tell me, is there complaints about this company? It may be regulatory bodies because people usually they're calling certain phone numbers. I'm gonna check, is there phone number on the taxi, right, on the vehicle? Then I'm gonna chase that number, I'm gonna go to the manager which is responding to that number and say, how many, give me the records of that log to see is there any. The other thing is external can perform again online search. That's the easy now. Go check the social media, everything is there.
I forget that one with CRA on how they're catching influencers that are not paying taxes.
Yeah.
Yes. Very true.
Just you have this ability to have this. Use the technology. Don't forget, you have available technology now to do all the things. And auditor and the Canada Revenue, they are using it. Artificial intelligence. I'm going to use the artificial intelligence in my benefits. Why should I be scared, right? And the last thing is the candidate discuss whether the external auditor will be able to rely on the work of that quality control team and make recommendation regarding the team to ensure the reliance of the possible going forward. So let's see what that quality report team is consist of. So structure of the work team is the client is responsible to identify process and procedures where the improvement can be made. However, there is no formal document, okay, outline the role of this in the team reporting structure. The team tests both financial and non-financial processes. Jason uses his professional judgment to decide what to review. Okay, his professional that's why he decides, and to choose the next project once the current one is complete. The controller approves the team budget, responds to the team recommendations, and approves the team new hires. Francois has indicated the interest of enrolling in the internal audit program, but has not yet done so. His work is not always reviewed in a timely manner. Although all of his work and reports are reviewed eventually, the controllers sometimes receive audit reports before they have been reviewed and before the efficiency of the work performed has been addressed. So you have so many material here to work with. No procedures, no process, professional judgment, incompetent, late reports. During the year, the team audited internal control indeed intended to mitigate significant risk operation and did not report any deficiency. Okay, okay, so that's kind of comfort on the team. And the team has not yet had opportunity to audit Ruby internal control. Although preliminary discussion with Ruby former owner suggests that he has strong control in most areas. Jen has asked Jason not to question Ruby management when the team does not being to perform such an audit, because it's important that the relationship with Ruby management is strong prior to the completing step 3. Jen does not want them to feel they are being criticized. Another problem here. Why is that? Right? So let's go now to the last part and see what they going the competency, not that one. Where we are? Audit, right? Auditor would be able to rely. Yes, that's the one. So should external auditor address? Now we're going to the objectivity. How objective are those people? Team does not document reporting structure. The fact that the team appears, the control is likely to control the external auditor. Should the team raise concerns regarding financial reporting, internal control, the team could be pressured. So therefore, I recommend a reporting structure be changed such that Jason report directly to Jen, and preferably a board of director if one exists. As a part of this, Ruby management prior to completing instructed not to questioning. Okay. But here you see here we should external audit be interested in relying the work of the Q team that will be treated internal audit using the work of the internal auditor. So you have here document which you have to use. So those are, since those are specific, please make yourself a note. And every time when you see something like this, as you can see, usually on the audit and the last 2 assessment opportunities, they ask you for some specific reports, special reports. It's always like that on the audit. And the last 2, they ask you 2, 3, they ask you for those special reports. So you have to be familiar with the special reports, and once you see something like that, which report you have to actually use. And to throw something from the standards, audit standards. So the next one, competency. We're gonna ask for the objectivity, internal organization, relevant policy procedures, support of objectivity. You see here, everything is driven from this document. That's why we are asking about the objectivity. Second, level of competency, and whether the internal audit function applies in the systematic and discipline approach, including quality control. So that's why we're asking, questioning here objectivity, because that's what we have to do. Second one, competency, and then with the systematic approach. Competency, obviously, only one person is competent, the other one, who knows what they are. The other three, actually. And as such, it's recommended that the funds immediately enroll in and competence certificate internal auditor program to develop the required knowledge. All right, that's the one. And the systematic approach is the project. Yeah.
Mm-hmm. No, I was just like saying systematic approach is like seeing like what they've done so far.
Right.
Yeah.
Everything is based on his professional judgment. That's great, but there has to be something more.
Yeah. Yeah.
Right?
So I was right. Overall, it is unlikely that the external auditors will be able to rely on the work of the team for the audit for
No.
financial statement.
No.
How come?
Right?
But that's what they concluded. They
Right?
concluded that overall we cannot rely on them, right? Which
Yeah, at
means
the
like
end, right at the very end, right? It's unlikely
yes.
the external auditor will be able to rely on the work of the team.
But then now that's why I'm saying now come back to that approach situation that I was mentioning on approach. There is no way we should have been saying we can use combined approach
Right.
because
Right.
because we concluded that saying no, we cannot rely on it. So
Right. Yeah. Yeah. That's a little contradiction, but what can I say? Right. So the thing
yeah.
is, the whole thing is, whatever you recommend, you have to justify it. As long as it's justified, as long as it's logically based on the previous discussion, it's a logical conclusion, they're gonna buy it. Literally,
Okay.
right? That's where you have to be.
Okay.
Okay.
Okay. So
Oh boy, that was a crazy case.
it is
But
long, but wait till you see the financial reporting and MA in there. It's crazier. The
is it?
MA was actually, yeah, the MA was so bad because, like, I feel like this case was not, it's not as structured as the way they bring the other cases. It was all over the place, and you had to go and look and understand. You had to actually understand the, like, even like the business itself, the business model to get the numbers right. It was
Right.
so terrible. But now that I'm looking, FR, I don't think FR is too bad compared to MA. MA is a
No.
hit or miss.
Well,
FR
so
is much more
basically, so
easier.
that's why let's fix first the audit, right? Let's stay on the audit. So I want you to excel in the audit, literally to excel in audit. And after
Okay.
excelling in the audit, as you can see, sometimes with the audit, we're doing some financial report, not so much. We're not spending too much time right now on the financial reporting because I want you to stay with the one structure of the answer. And the way you answer audit questions, an audit assessment opportunity, is not the way that you answer financial reporting issues.
Okay.
As you can see, right? In the audit, we have one structure of the answer. They're asking for one specific things. On the financial reporting, there's only one structure and one structure only. Standard, apply the standard, small picture, adjustment, big picture. Move to the next one.
Okay.
Right?
Okay.
But
Sounds
let's
good.
leave it the financial reporting for now. We're gonna go to the financial reporting when we're gonna fix the financial reporting when the time comes. Right now,
Okay.
let's get your role first.
Okay. Okay. Sounds
Okay?
good. Okay.
All
Yeah.
right.
Okay. Thanks. So let me know tomorrow's case because this one I'm gonna finish debriefing it tonight.
Okay.
I'm gonna redo it.
Let's do 2021. Which one I have? Just a second. I'm gonna tell you exactly which one we can do tomorrow. Let's do we did 2022. Let's do September 2021.
Okay, September
Let me see
2021.
if that's the one that I have. Yeah. Yeah, September 2021. Let's do that.
Okay. Okay,
Okay.
sounds good.
Okay. 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 Good
Okay.
job
Thank
today.
you, Ivan.
Thank
Thank
you.
you.
Thank you. Thank you
Okay.
today. Thank you.
Bye.
Bye.